Just send us a message in the chat window. I'm about to get started. All right, let's get going. My name is Todd Harrison. Hello, welcome to the Fireside Chat. It is Wednesday, June 19th, 2013. I am honored to welcome to our Fireside Chat this month Mr. David Stockman. David is a former U.S. politician and businessman. He served as a Republican U.S. representative from the state of Michigan, the great state of Michigan, and as the director of the Office of Management and Budget under the Reagan administration from 1981 to 1985. David has also written a terrific book. If you have not read it yet, I urge you to read it. It's a pretty eye-opening account of his interpretation and dare I say, many of the things I feel as well in terms of what's going on in this country. It's called The Great Deformation: The Corruption of Capitalism in America. Jives quite nicely with a couple of items today. My article this morning, The Waning of Integrity of U.S. Financial Markets, as well as the Federal Reserve Open Market Committee. Welcome, David. Welcome to Minionville, and thank you for your time today.
Well, happy to chat with you on a warm June afternoon.
Yes, it is warm.
Yeah.
And if David appears to be perspiring, it's because the air conditioning is not functioning. It's not because of my questioning.
Yeah.
But to kick it off, David, I know you've worked real hard on this book, a terrific book. Maybe for those who have not read it, if you could just give us a top line, if possible, in terms of what you were hoping to accomplish by publishing that book.
Well, yes, it's a 100-year revisionist history of how we got to the mess that we're in today. I think the Main Street economy is failing. We've really had no middle-class job growth since 2000. In fact, we've lost about 4 million jobs. Real median family income is down 8 or 10%. Household net worth for the bottom 90% is actually down 25% from where it was at the turn of the century. Now, notwithstanding a clear trend that is very worrisome and negative, we have had massive, unprecedented government intervention, both fiscal policy and especially this out-of-control money printing that we have at the Fed. At the time that the economy began deteriorating, the Fed had a balance sheet of $500 billion, and it took 94 years to get there. Today, obviously, it's $3.4 trillion, and all of that money printing has simply created serial bubbles, has turned the financial markets into gambling arenas, has really destroyed what I call honest price discovery, where supply and demand and investors looking at the future, discounting risks and cash flow and earnings and so forth, set the price of securities, equities, bonds, commodities, and everything else. So we have a corrupted system that's failing, and it's failing because policies at the central bank and in the fiscal arena have simply abandoned all traditional standards of fiscal rectitude and sound money. So my book is about how we got here, step by step, how it evolved, when the great mistakes were made, when the great inflection points occurred, such as 1971, when Nixon closed the gold window at Camp David and began us down the road to this activist discretionary central banking and all the other ills that we face today. So that's kind of, a big picture, high level précis of what I'm trying to deal with. And there are many different dimensions that we could talk about.
Yeah, well, I mean, in terms of the system formerly known as capitalism, as I often call it, because I agree with you that this is not a free market, and we've gone down a road now where, quite hopefully, we can get to a place where securities trade free and clear the market as a capitalist market should, or was designed to do, I should say. With Chairman Bernanke top of mind, having spoken on the Hill today, he was perspiring for an entirely different reason. I assume that the air conditioning worked there. I'm going to start off with a straight, right down the middle question. If you were the Federal Reserve, what would be the first three things you would do on your first day of office?
Well, I think if I were Bernanke, I would quit. because he is wedded to an academic doctrine that I think is just kind of a crude form of Keynesianism that says we can model the economy, we can turn the dials, you know, in terms of interest rates, in terms of liquidity flows into the market, in terms of word clouds and verbal assurances that essentially permit a monetary central planning. We have been on that path since Greenspan essentially invented it, experimented with it, and you know, matured it, I guess I would say, during his 19 years. Now we're so far off the deep end that we essentially have a whole financial system being run by the Fed, trading against the Fed, and therefore having no real, what I call free market integrity. Now you need to abandon all of that. So you're asking me what he should do. I don't think there's anything he could do since he believes in that. He's a pure Keynesian. And the best thing for him to do would be to resign and let somebody like Tom Honig or Sheila Bair or somebody, the son of Paul Volcker, if there is one, who has some more modest sense of the role of a central bank to take over the job. And in the process, there's probably a half a dozen of the rest of them on the Open Market Committee who ought to turn in their badges as well. We simply, you know, we're off the deep end, I think, in terms of a rogue central bank that's out of control, and we saw tremendous evidence of it today in what I think was the pettifoggery that emitted from the chairman for the entire length of his press conference.
I hear you, and I do agree with you, but you know, we're so far down the road now, you know, it's almost like giving a drunk another drink with hopes he doesn't sober up. A very Fed-dependent market. You know, I look at the market as a trader, and you know, I'm not alone in this. I look at what Stan Druckenmiller said yesterday about how the market is rigged, and I think it's hard to dispute that. But if we were going to walk down a path of fixing or repairing, and I think there's two conversations. There's the structural conversation, and then there's the psychological conversation, the trust, the truth and trust behind the system. But what, I mean, is it fixable? I mean, is there any steps we can take that begin to move us back in the right direction?
Well, I think there probably are, but I think they would be considered very antiquated and archaic in today's environment with the mindset that seems to have, you know, enveloped the entire system. Yeah, I listened to all the journalists at the press conference. They seem to think that the Fed knows what it's doing, that this is all just fine, that somehow this is consistent with monetary policy traditions and histories, and of course it's not. So I go back to Carter Glass. Everybody knows Carter Glass. They think that Glass-Steagall was a good thing. But actually go back to 1913. He was chairman of the Banking Committee. He's the author and father of the Fed. And you find two startling truths about what happened when the Fed was created. Number one, it was not allowed to own government bonds. It could not be in the debt market. It could not have even contemplated QE or interest rate pegging or management or rigging, because none of that was in its remit. Instead, it was meant to be a banker's bank operating a passive discount window that commercial banks who had good collateral, genuine receivables or inventory loans from business could bring to liquefy at a penalty rate of interest, with the underlying interest rate, and this is crucial, this is critical, being set by the free market, by the interplay of supply and demand and savings and borrowers, investors, and so forth. That was the original model. That would allow for a central bank to let capitalism breathe. It would deny all of the targeting and pegging that we do today. Carter Glass never thought the Fed was to manage GDP, or M1, or M2, or the unemployment rate, or the inflation rate, or the housing starts, or any of the other multiple variables that they're trying to manipulate today, as you heard in Bernanke's press conference. That's the dramatic, stark contrast between a banker's bank, which I believe is consistent with free market capitalism and growth and honest pricing and integrity in markets, and what we have today, which is monetary central banking, in which the entire multi-10 trillion capital and money markets are being managed and run by 12 people on a monetary politburo. So that is the contrast, and whether we could get back to 1914 or not, obviously is maybe even a silly question, but the model tells us where we should be going, and we're not even remotely in that direction today.
Well, the bulls will argue that we're on our way to 1914 in the S&P, you know, and I bring that up half jokingly, you know, because, you know, the market's up 150% since the March low of 2009. Peter Atwater at Minionville had a great quote. He said, in the first phase of the financial crisis, the sovereign lifeguards saved corporate America. Who's going to save the sovereign lifeguards? And it's a very interesting question, and it's one we've been talking about, but the market doesn't seem to care. The market goes straight up, and we could talk about the why and the where, but as a trader, you know, you're supposed to, you know, make money at the end of every single day, or at least invest in your money. We could talk about the reasons, but at the end of the day, the market continues to go higher. So my question is, you know, is there potentially, you know, in the interest of seeing both sides of the conversation, is there a bull case here that, you know, this is the U.S. government, they are the judge and jury of this financial equation. What precludes them from swallowing hard and writing off this debt, this toxic debt one day, and saying, you know, it never really existed in the first place. They're just going to hold it to maturity. And you know, I'm trying to see both sides here.
Yeah.
I agree with you, but you know, is there a case to be made that they can make this go away in the interconnected world that we live in?
Well, I think the starting point is, let's shed the recency bias. Yes, the market is up 146% from the bottom, but that's only from the last bust. If we go back to March 2000, the market's up about 3.5%, the S&P 500. In the interim, we had the dot-com bust, trillions lost. We had the housing reflation and bust, trillions lost in the middle class in Main Street America. We had the Lehman collapse and meltdown in 2008, trillions more lost. So basically, we've been oscillating up and down in financial markets as a result of the serial bubble making of the kind of monetary policy that we have today that fuels massive liquidity into the market. It doesn't go today any longer into credit and therefore goods and labor inflation. It goes into inflation of financial assets, to carry trades, and to speculation based on the fact that traders believe that the Fed has their back. So my point would be that, you know, yes, the market's up from the latest bust by 146%, but we lost 5 million middle-class jobs in the Great Recession. We've only regained about 18% of them, the way I count real middle-class jobs. So the market may be going through another bubble expansion. Look at the Russell 2000, look at the junk bond index, look at the speculation even in things like Fannie Mae preferreds and the stock of what are essentially nationalized corporations, and you can see speculation is back everywhere. That's what the Fed policy produces, but it doesn't produce real, tangible, sustainable economic expansion and wealth in the Main Street economy.
Well, perfect segue to my next question, which is coming in from somebody who's listening to us. You know, given what you see and what I agree with you in lockstep, I've been writing about this for a long time. You're obviously much smarter, well-read, and better looking than I am. But where does one put the majority of their wealth to protect their wealth going forward? I mean, in this environment where truth and trust are commodities, sad but true, you know, how do you protect your wealth in this environment? Where do you go? Where can you feel safe?
I think it's very difficult to feel safe, and Bernanke said something this afternoon that I think underscores the tragedy of this whole policy that's evolved since the Greenspan era. He said, the committee judges that we will keep the overnight rate at 0 through 2015. They put it there at the end of 2008. They're saying that for 7 years, if you're a saver who needs liquidity, who wants to keep his or her money in a CD or a bank savings account, we decree as the Monetary Politburo that you are entitled to no return, nothing, as a result of maybe a lifetime worth of thrift. And on our command, you shall chase a high-yield mutual fund or buy the ETF for the Russell 2000 or some other risk asset that we deem instrumental in reflating the economy as we see it. That is so wrong. That is such a violation of fundamental economic principles, to say nothing of democratic rights, that I'm amazed that the country has, acquiesced to this kind of policy. And yet that's exactly where we are. Now, why am I saying this? Because I'm saying if you want to protect your wealth, preserve your wealth, you have no choice except to put it in cash, short-term, liquid instruments, earn nothing, and take your punishment, because that's what the Fed in its wisdom has decreed that you deserve. That is a pretty sad statement, but I think that's the only thing that people can do. I don't think we're going to have a great inflation. I think we're going to have a deflation and austerity, a failing economy for a decade or longer to come. Therefore, cash will be safe. And you're better to preserve your wealth, in my view, than get into harm's way. Now, this is very difficult for young people who are still trying to work out of their student loans or who are trying to build a net worth for a lifetime. They have been consigned to this kind of, position of zero return as a result of the Fed. They're setting the market. They even say we're setting the market, and they certainly are.
So you don't see any dollar risk, or you think it's just the less of many evils, the least amount of harm could come to you by putting in cash. But I would assume that in some scenarios there is a debasing of the dollar that could, the gold bugs, which I've never been on that train, will argue that the dollar is going to debase. I would argue back that it already has since it started out. But you think that in terms of preserving wealth, you just sit in cash like a lot of investors seem to be, and you just take your lumps over the course of time.
Yeah, because if you count your wealth in dollars, all the central banks of the world are doing the same thing. Bernanke today congratulated the Bank of Japan. That's a worrisome thing in itself. My gosh, the Bank of Japan is almost defying monetary lunacy in terms of what they're doing today. The ECB has a little more sort of indirect way of doing it, but they're monetizing. Their balance sheet is $4 trillion. The ECB, the Bank of the People's Printing Press of China, as I call it, they're all doing the same thing. So therefore, the dollar as a currency is likely to preserve its value, if not appreciate, against the rest of the sad lot of central bank monies that exist out in the world. But I don't think we're going to get to a consumer price runaway inflation, because we're likely to have a breakdown of the bond market anytime as a result of this huge bubble that's been created.
Yeah, we've talked about that. We're 3-4% away from all-time highs, which is pretty crazy. We talk a lot about the chasm between the fact that we're near or at all-time highs versus the fact that nobody really feels like we're at all-time highs, and that social mood and the way that's manifesting and playing out. And to your point, inflation and things we need, be it education or food or energy, and deflation and things we want, goods and services or iPhones or laptops. But through, just looking, shifting, getting more questions here as I'm reading, just looking through a broader lens, given the long-term liabilities in Medicare, Medicaid, in your view, is there any reasonable, realistic way out of these obligations? Is there any ray of light other than hunker down and wait it out?
Yeah, I don't think there's any realistic way out, and it's a good thing you mentioned those entitlement obligations that are massively understated. What I try to lay out in my book is that the budget mechanism, fiscal policy, has become a doomsday machine. If we do an honest projection of the economy for 10 or 20 years, let's say doing no better than it has for the last 10 years, I don't see why it's going to get any better. There are headwinds all over the world. So if it doesn't do any better, we're adding $15 trillion a decade to the national debt. And as the population gets older and as that debt mushrooms, we're going to have higher and higher taxes. We're going to have more and more political conflict about benefit changes and reforms and cuts and deferrals. And our system is going to become entirely, let's say, paralyzed, caught up in political conflict over the due bill that's been created over the last 30 or 40 years, where when the bubble was inflating and when we were raising, you know, the leverage level dramatically in our economy. So now we have payback time. We're going to have it for decades. These costs are going to come due, and it's going to weigh down on the economy. I think the age of economic growth is over. I think the age of rising living standards is finished. I think, you know, from here forward, it's not doomsday. We're not going into some Great Depression calamity collapse. We're going to go into a long, painful period of austerity and stagnation and conflict over struggle over the bills that we have unfortunately created.
Well, I don't know about everybody else, but I, for one, am pretty excited about that, especially with children, and it sounds like their children having to pick up the tab for this, for the decisions of policymakers. I continue to get great questions, so I'm just going to keep spitting them out until we run out of time here. Coming from Merrily, David, can you speak a little bit to the U6 unemployment numbers or employment numbers and how distorted the media is when speaking about employment, and any comments on the social unrest that is spreading throughout the world based on the high unemployment globally? We know what's going on in Spain and Europe, in Brazil now, in the Middle East. I have my own thoughts here. They're pretty well documented that this is contingent, but people want to hear your thoughts, not my thoughts. Any Greece, Spain, 50% youth unemployment. How does this reset?
Obviously, none of that's viable. I think it's going to lead to more intensifying political conflict. I don't know in the United States if it spills over into the streets or not, but I do know that it will paralyze what's going on in the Capitol and in our political process. I also want to point out the unemployment numbers are totally fraudulent. If you had the same participation rate that we had in 2000 at the turn of the century, the unemployment rate today would be 13%.
So, continuing.
I think I've lost you here, unfortunately.
Hello?
My screen went dark, but as long as you still have me, I'll keep talking.
I have you.
Okay, all right. I didn't know whether we were still on or not.
No, we certainly are. We have about 5 more minutes. And I have to ask this question. I'm a big guy. I'm big on looking forward, not looking back. But, you know, if you were in that room in 2008 when the wheels started falling off the wagon with Lehman and Bear and AIG, how would you have recommended we handle that as opposed to the way in which we ultimately move forward?
I would have handled it very differently. I spent about 60 pages in my book going through what I call the BlackBerry Panic of 2008. I think that Bernanke dramatically overreacted because he's a scholar, he says, of the Great Depression. I think he was wrong about the Great Depression and the role of the Fed. He simply Xeroxed what Milton Friedman said long ago, and Milton Friedman was wrong long ago. So there wasn't any Great Depression 2.0 around the corner. The meltdown was entirely in the canyons of Wall Street, in the basic last 2 gambling houses standing, Goldman Sachs and Morgan. AIG was not some contagious disease. It could have been put into bankruptcy. All the bad CDS it wrote was at the holding company. It could have been written off. The top 20 banks of the world had bought most of that CDS. They had massive balance sheet and plenty of equity room to absorb the losses. They essentially bought insurance from a holding holding company at AIG that had no liquidity. So shame on them.
But do you really, I mean, when you have everybody from General Electric to Target, you know, in a finance-based economy levered up with $1 quadrillion of derivatives tying the global finance-based economy together, you don't think that the contagion risk was genuine?
No, I do not think it was genuine. I've looked very carefully at General Electric. General Electric had $600 billion worth of market cap 2 weeks, by that I mean debt plus market equity combined, 2 weeks after the Lehman event, after Immelt had called Paulson with his SOS call. He could have easily funded a couple $2 billion a week of rollover commercial paper that couldn't be placed at an interest rate that he wanted to pay by issuing long-term debt, even if it was at a highly dilutive rate. Or, you know, the stock was trading at $20 a share. He could have issued billions worth of stock. It would have been dilutive. They would have, you know, incurred a hit to earnings. But that's what you're supposed to do when you fund yourself with hot money short in order to hold, you know, the massive amount of illiquid and risky assets that were at General Electric Capital. So I think there's total urban legends that have been created at the time in a couple of weeks of panic by Paulson and Bernanke. They had the whole town of Washington buffaloed. The sight of Congress being marched up the hill to pass a $700 billion TARP, sight unseen, spread fear. That was the real contagion that spread around the country. But there wasn't any threat to the Main Street banking system. There wasn't any ATMs that were going dark. We could have gotten along without with the decline in the commercial paper market. The money market funds, that's a whole myth as well. You know, there was a small amount of prime fund money that moved to government funds, but if you look at the totality of it, it was a 1 or 2% hit. So I think that was the Rubicon. We crossed it there. We threw all the rules out the window, rules of fiscal rectitude, free market operation, because a few people panicked in Washington when the last gambling houses were going down. I think the whole crisis would have burned out in a few days on Wall Street once Morgan and Goldman went under and AIG was put into bankruptcy. We do have FDIC. If they had to put Citibank into resolution, they could have done it. I just think all of this has now been you know, repeated so often as the end of the world that we believe things today that are not remotely true. It couldn't be true that 9 months later everything was great again, that Goldman Sachs in the following year earned $29 billion of net income and salary and bonus. It's not possible if things were that dire to have a turnaround that fast in 9 months. So I think all of that is wrong. It's mythology, and it's one of the reasons why we continue to tolerate the lunacy that's going on at the Fed and in Washington today.
Okay then.
There you go.
There you go. You know, having been in the market for 20 some odd years, I have a slightly different take, but certainly, you know, respect your view. Obviously, very informed. Last question, if we may. Obviously, there's a lot of discord, a lot of folks out there who are pretty pissed off, and rightfully so. Where do you see in this next election cycle? You know, what would you like to see, and what are your thoughts on the potential for a third party to emerge out of this chaos?
Well, I hope a third party would emerge, but I don't have a lot of confidence or hope. The two political parties today are absolutely in the thrall of interest groups and PACs and money politics and K Street and so forth. I call them glorified concierges. They introduce their politicians to the machinery of re-election. They don't really stand for much. And so I think our governance process is broken down. I think we have a completely failed political system. And yet, until we have some kind of shocking, dramatic financial collapse, I see little reason to think that anything will change. Maybe in the next election, the Republicans pick up a few more seats, but you know, what difference does it make? The Republicans created as much national debt over the last 28 years as did the Democrats. The Republicans have violated the rules of free markets with equal abandon as did the Democrats. The Republicans have never done anything about the huge entitlement bill that's coming due that we've been talking about earlier. So I think, you know, the political process is more or less hopeless. The two parties are basically in the business of perpetuating themselves, so we continue to drift with a central bank that's out of control and with a budget that's essentially a doomsday machine.
Is there anything that you're excited about?
Well, I'm excited about how bad this is and what it's going to take to get the people of America to wake up. I think when the big collision and breakdown comes in whatever form, I think it's going to be a total thundering crash in the bond market. This is entirely artificial, totally levitated by the foolishness at the Fed. So that when the thundering crash comes, maybe the people of America will get out their torches and pitchforks and march on Washington and march on the Fed and demand fundamental and sweeping change. But until that happens, I think it's just more of the same kick the can, status quo, make pretend Fantasyland world that we heard in living color this afternoon during Bernanke's press conference.
Well, perhaps after the pitchforks, then there will be a full rebirthing based on economic truth and meritocracy.
Hopefully.
So there is something to look forward to. David Stockman, thank you very much. This was awesome. A lot to think about. If you have not gotten his book yet, The Great Deformation, The Corruption of Capitalism in America, highly recommended. David, thank you, and please take care of yourself, and I appreciate your
Okay, thank you very much. Enjoyed talking with you.
Thank you.
Great.